Hi and welcome back to another video. Today we're going to be analysing two of my favourite companies or favourite stocks in the world, Visa and Mastercard. This video, or stock analysis and valuation, was solely supposed to be focused on Visa, but I thought if we're going to talk about Visa, we may as well package Mastercard into this as well because it's a very similar business, exactly the same business model, and they post very similar results. So maybe Visa will focus in on and then also look at the end at the valuation at Mastercard and see maybe what offers the best value out of the two and put a price target to buy for both of them in case they do dip, because these are two companies that are very high quality businesses, very high quality stocks. You can see the stock performance here over the past decade. They've probably been two of the best stocks that you could own over the past decade in terms of volatility, and just a straight line up if we take 2020 out of the equation. And I do actually own Mastercard and not Visa, which is another reason why I'm trying to package in Mastercard to this and talk a little bit about why I maybe bought that. And ideally, I'd like to have both companies as flagship positions in the portfolio. They are very high quality businesses, very predictable cash flow and predictable growth going into the future, but they have gone through some struggles in 2020. The stock price really did dip, as you would expect. Payment volumes were down, so therefore revenue for Visa and Mastercard would have been down also. So we'll look at whether this has created maybe a buying opportunity because the flatlining of the stock over the past year, or whether actual headwinds have been created for the two companies going into the future. If you didn't know already, both of these payment companies charge financial institutions, or the banks that issue your cards, a fee based on the gross dollar volume spent on your account. And it's usually a percentage fee as well, so the fee is for handling the processing of the payment in a quick and secure fashion. They also earn additional revenues for other things like authorizations of transactions and cross-border transaction fees and things like that. So they represent very sticky businesses that are ingrained into how society operates and works today, and also act as a good hedge against threats such as inflation due to their relationship with prices and spending. And obviously inflation is a very hot topic at the moment. So I'm going to jump straight into the numbers on this one. Look at the financials for both of these companies. And we can see that they're very similar in nature, right? Growth has been very similar. They're both very profitable. They both struggled in 2020. Mastercard a little bit more than Visa. You can also see that Visa is a slightly bigger company at 21 billion of revenue, with Mastercard only at 15 billion. Also 10 billion of net income versus 6.4 billion of Mastercard. So Visa's a slightly bigger company, but you are paying 540 billion for the entire company versus 380 billion for Mastercard. But firstly, I just want to talk about 2020. And obviously these companies dipped in 2020, like we see here. Mastercard 9%, Visa 5%. But really, this was the worst year for both of these companies, probably in the past decade, and probably at least for another decade, or maybe even more as well. So when a company's down 5 to 10%, but remained highly profitable and still spat out 6 billion and 10 billion in net income in their worst year in a decade, or arguably even more, that to me is a very defensive business, and both of them are. And we can see here, unfortunately, even though they did have one of their worst years in 2020, they were almost rewarded for it, especially Mastercard. If we look at that, they've gone from $295 per share in 2019, or at the end of 2019, to $382 per share today. So over a 25% lift in the stock price, even though earnings and revenue have sunk almost 10%. Similar sort of thing with Visa, although it was getting a little bit frothier anyway before Mastercard. 43 times earnings back in 2019. Now at 50 times earnings. So both of these companies now are the most expensive they have been over the past decade, even though they're going through probably their most torrid time. So why is this? Why have we seen a 4x in Mastercard's stock price in the past 5 years when net income hasn't even doubled? And why have we seen a 3x in Visa's stock price when they've only managed to grow revenue at around 15% and earnings at around 17% over 5 years? Well, like I said earlier, it's probably somewhat reflective of the underlying business quality. It's been almost impossible to pick either of these stocks up over the past 5 years under 30 times earnings. I think you had once in 2016, going by these numbers here, that you could actually pick Mastercard up below 30 times earnings, but not a period here where you could pick up Visa under 30 times earnings. Right? In a normal world, both of these companies are going to produce a lot of cash flow. They're going to produce a lot of earnings, like we see here. Very high profit margins, very high returns on capital, and we will eventually make it back to normality. And these businesses will see, a good lift out of it. I think the consensus is that they might get a 20% lift in the next sort of 18 months from the boost of all the global economies reopening. But a 20% lift, in 1 year doesn't necessarily cover 59 times or 50 times earnings. The math just doesn't work on that. However, what's most likely, and this is where we're going to diverge a little bit and talk about market valuations in general, is, I believe, the wide acceptance of lower returns in the market by investors. And people need to be careful they don't fall into this trap, unless they want to, of course, or believe that it's the right way to invest. But for example, one of our Discord members, Tamo Tam, shout him out, very active Discord member, kindly posted an interesting bit of research done by Professor Damodaran, the valuation teaching legend himself. And it was a tweet, and in his tweet he stated that the implied equity risk premium currently stands at 4.1% because of interest rates and various other factors in the macro environment at the moment. So in other words, the price of risk. And without going into too much detail, equity risk premiums are widely used in valuations, or seemingly used in valuations, to determine the cost of capital or discount rate which should be used. And the equity risk premium makes up the bulk of the discount rate, right? Meaning that going by Asworth's estimations, investors should be using a discount rate of anywhere between 5 to 7% to fairly value stocks, right? A 5 to 7% required rate of return. And this is because it reflects the lack of alternative investments or yields that are available to you, and calculates a sort of opportunity cost factor. Okay, this is how a lot of people feel you should be valuing stocks at the moment. You should be factoring in the lack of opportunity that exists out there in the market. But as I always say, your discount rate will reflect your annual rate of return. If you're using a discount rate as low as 5 to 7%, your returns will likely be as low as 5 to 7%, which if you're okay with that, then that's fine. But that's why we're seeing S&P companies selling at 30 to 40 times earnings, with earnings growth expected to be less than 10 to 12% going into the future. It's also probably why we're seeing companies like Visa and Mastercard, very reliable companies in times of normality, selling at 59 and 50 times earnings when their realistic earnings growth going into the future is around 12 to 15%. And funnily enough, using Asworth, or not just Asworth, but the widely used discount rate of around 7% at the moment, both of these companies look fairly valued. And it makes a lot of sense, with investors seeing these two companies as predictable and secure returns that could have some upside potential if the businesses outperform their expected 12 to 15% growth rate. But unfortunately, with my 15% required rate of return, as I want to beat the market, these stocks are both overvalued. If we look at Mastercard as well, both overvalued. Mastercard by about 49% and Visa by about 44%. My target price for Visa would be $154 per share, which we did see back in 2020, and $255 for Mastercard. Actually, we could probably put a 14% here because of their dividend that they have as well, and they're growing that dividend year on year. They also do buybacks as well, so we could drop it to 14% if we want to be really fair and reflective of the quality of business that they are. So 162 and let's say 267 for Mastercard. But hopefully this serves as a lesson for some. Investing, at least in my opinion, more specifically value investing, in whatever realm you see it, whether that's growth or just traditional value, is about straying away from the herd, not following it. And we hear all great investors talk about straying away from the herd and talking about how that's helped them outperform the market over time. They tell you this in one way or the other, whether it's the ability to sit patiently and wait for a fat pitch and discounted prices like Buffett and Munger say they do, or having a competitive edge in certain fields by knowing more than others in the industry. Eddie Lampert is a good example of that in real estate. Or sometimes it's even just buying a few great businesses at fair prices and never selling. For that, you have to be concentrated in a few names and not be wrong about their future. So you have to be a good stock picker. Also, have the confidence to hold through the bad times. And Chuck Akre is probably a good example of this. Now, lastly, I'll talk about my Mastercard holding and why I would still hold Mastercard, even though based off of my model, they're 42% overvalued. Why would I still hold that? Well, I bought Mastercard back in 2020 after the dip from the coronavirus. So I saw the stock sink down to actually as low as about 230, I think it was. I didn't pick it up until the 260 to 270 range. But I was buying Mastercard at 36 times earnings, which isn't massively cheap. but by my estimations, it was enough to conservatively get to a 15% annual rate of return for 5 years or more. As you can see here, the fair price at a 15% required rate is around $260 to $270 per share. And the story's not done with Mastercard. This is a company that I see that probably has one of the most long-lasting moats out of any businesses in the world at the moment. Although a lot of people think that there are new fintech businesses, new payments businesses coming in that are going to disrupt the likes of Mastercard and Visa. But I honestly think the power of this duopoly is underestimated. So I'll continue to hold Mastercard probably for the next sort of 3 to 5 years until it reaches my full price target and I've met, hopefully, a 15% annual rate of return with it. But lastly, I'll just show you then the implied rate of return for both of these stocks in my IRR calculator based off of the forecast that I made. So the forecasts were around 13.5% EPS growth or free cash flow growth over the next 5 years, which is around about the consensus estimate and where I think they're likely to land. And we can see from Visa, the expected return is around 9.5% from the current stock price, and then around 8.6% for Mastercard. But that's mainly because Mastercard has made the biggest move upwards in recent months, while Visa's been pretty much stagnating. And like I said, there's a potential for both of these companies to outperform. A lot of people think these businesses have reached a peak, but when you think 60% of all transactions in the world are still in cash, and the majority of the migration to digital over time will be consumed by both Visa and Mastercard. So have a think about that. The story's not done for both of these companies. And that's about it for this video, guys. I know it took a bit of a turn from analysing the businesses because they were overvalued to actually talking about valuation methods and principles and practices, etc. But hopefully it was good food for thought anyway, and we now have a collective idea of what sort of price we should be paying for both of these stocks if you want superior returns, what sort of return you could expect if you're happy buying the stock at the current prices today. So I'll be adding both of these to the watch list or tracker of stocks that we valued on the channel, and this is available to all of the Patreon and Discord members. So go and check that out if you're interested in supporting the channel and getting some benefits to go with it, along with both of these individual valuation models. And don't forget to like the video if you enjoyed it. Comment, let me know what you think of Visa and Mastercard and the current valuations of the two. Subscribe to the channel if you haven't already. Good luck with all your investments. I'll see you in the next video.